Over the past week, a number of stocks suddenly saw a huge drawdown. But this sell-off was not across the entire market. Instead, it was concentrated mostly in software companies such as Salesforce, Adobe, ServiceNow, and Intuit. Because when you zoom out and look at the broader market, the S&P 500 is still trading close to its all-time highs. And it wasn't even a full tech crash either, because even the triple Q is still holding up relatively well. Sorry to the US bears, you might just have to wait for a while more before you get it right. Instead, the crash has been very specific. Software stocks in particular have been hit hard. Since the end of last year, the iShares Expanded Tech Software Sector ETF has been trending down sharply, with the sell-off accelerating in recent weeks. So what has actually caused this sudden panic? Apparently, what triggered this sell-off was Anthropic releasing a new set of enterprise AI tools, including its co-work style capabilities. These tools are designed to automate real business workflows across areas like legal, finance, research, and even coding. And the fear is that these AI tools could partially or even entirely replace parts of today's software stack. In fact, this concern has led to some investors calling this as an existential threat to some software companies. So in this video, let's go through what you need to know about this software sell-off. What exactly is AI disrupting in this software stack? Is this sell-off just another market overreaction and a potential buying opportunity? Or are we looking at a structural shift that could permanently change how software companies make money? So first things first, let's understand what AI is actually going to disrupt. My friend Bunty here has a chart which explains this very well. I'll leave the link to his video down below if you want the full breakdown. But essentially, when you talk about software companies, most of them operate across three different layers. The first layer is the interface layer, or what some people call the system of interaction. This is what the user actually sees and interacts with, things like your websites and apps. Underneath that, you have the business logic layer. This is where all the workflows, automation rules, permissions, and processes live. For example, how leads get routed in a CRM, how approvals work in HR software, or how tasks get assigned in a project management system. Then right at the bottom, you have the database layer, also known as the system of records. This is where the actual data is stored, such as your customer records, financial history, compliance logs, and years of operational data. I know this because, I'm something of a software expert myself. But anyway, different companies dominate different layers. For example, companies like Oracle traditionally focus heavily on the database layer, aka system of record layer. The same goes for companies like MongoDB, which specialize in storing and managing massive amounts of data. On the other hand, some companies operate much closer to the interface layer. Think about Zoom, where most of the value is the meeting interface, or Slack, where they specialize in communication, or Wix, which provides a front-end website creation experience. Here's the same chart, but from a different article. What this shows is that AI has the highest potential to disrupt the presentation layer and parts of the business logic layer, because AI agents can now generate interfaces, automate workflows, and execute tasks without needing a traditional software UI. Meanwhile, the database layer is much harder to replace because it contains years of accumulated institutional knowledge, compliance history, and proprietary data that companies rely on to run their operations. So what this means is that companies that sit closer to the database layer or system of record layer tend to have stronger moats and lower disruption risk, because switching away from them would be painful, expensive, and may even be operationally risky. In contrast, companies that mainly provide the interface or workflow layer are more exposed to the risk. For example, if an AI agent can recreate the same functionality faster, cheaper, or even for free, the customer may no longer need the software subscription in the first place. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. So this chart here basically shows what the market is afraid of right now. On the x-axis, you have how fast each company is expected to grow. And on the y-axis, you have how much investors are willing to pay for that growth. In a normal environment, most companies should roughly sit along this line, where the faster you grow, the higher valuation investors are willing to pay. However, because of AI disruption fears, companies are no longer valued purely based on growth. Instead, they are now being valued based on how replaceable their products might be in an AI world. For example, look at Palantir, which sits all the way at the top right of the chart. Palantir's core business is not just a nice interface. Their real value is helping companies organize messy enterprise data into a single source of truth. In other words, they operate very close to the database and ontology layer. That's because AI agents actually need clean, structured data to function properly. And without data, AI is useless. Because of that, platforms like Palantir are seen as the operating system that AI runs on, rather than something that gets replaced by AI. That's why investors are still willing to pay a very high multiple for its growth. This is the same story with CrowdStrike, which also trades at a relatively high valuation. CrowdStrike sits deeply inside the security infrastructure layer. Their Falcon platform collects trillions of security signals every single day. And because cyber threats are getting more sophisticated, security increasingly needs to be automated and AI-driven. So instead of being replaced by AI, CrowdStrike is actually using AI to strengthen its product. That keeps both its growth expectations and valuation relatively high. Now, compare that with something like Duolingo. Even though Duolingo is growing quickly, the market is giving it a much lower valuation. That's because most of its value sits at the content and interface layer. So, the risk here is that if AI can generate personalized language lessons instantly, then Duolingo's moats would become weaker. And over to the left, you see DocuSign. DocuSign's core function is basically an interface for signing documents. But signing is increasingly becoming a built-in feature inside larger platforms like Google Workspace or Microsoft 365. So if AI agents can generate, review, and execute contracts end-to-end, this standalone software would become less essential. That's why the market is giving DocuSign a much lower valuation, because it is pricing DocuSign more like a commodity tool rather than a critical platform. Interestingly, Intuit sits much closer to the line. That's because taxes, accounting, and compliance are still mission-critical workflows. Even though AI can help to automate parts of the process, companies and individuals still need a trusted system of record to file accurately. Because of that, investors see Intuit as less likely to be disrupted, which is why its valuation looks more normal relative to its growth. And then you have Adobe. Historically, Adobe's strength came from being the best interface for creative work. But with generative AI now able to produce images, videos, and designs from a single prompt, investors are starting to question whether their interface remains as defensible as it used to be. So even though Adobe is still a very profitable and dominant company, its valuation multiple has compressed because the market is no longer willing to pay the same premium for the company. Now, the big question is, how much of this fear is actually justified? Because if we look at history, we have seen many situations where investors initially overreacted to a new technology only for those fears to turn out to be largely exaggerated. For example, when new low-cost AI models like DeepSeek were first introduced, there were immediate concerns that companies such as Nvidia would lose their dominance in the AI space. And yet, within months, Nvidia's business continued to strengthen as demand for AI infrastructure kept rising, and the narrative quickly shifted from disruption to expansion. A similar story played out with Google. When generative AI tools first went mainstream, many believed that traditional search would become obsolete. Instead, Google integrated AI directly into its ecosystem, and its core search and advertising businesses remain highly resilient. So with that in mind, I've identified the current fears around software into two main ways as to how AI could potentially disrupt the industry. The first is what we call wipe coding, where software interfaces and simple applications can be generated quickly using AI tools. The concern is that if software becomes too easy to build, many existing SaaS products could lose their value. However, as we discussed earlier, the true value of a software company is really just about the user interface. Much of its moat comes from the data it owns, the workflows it has embedded into customers' operations, and even the broader ecosystem surrounding the products, such as integrations, compliance, features, customer support, distributions, and years of accumulated operational knowledge. One good analogy is the Apple ecosystem. Even though there are many cheaper alternatives in the market, if you are already using the MacBook, iPad, iPhone, and so on, you are already deeply embedded into Apple's ecosystem. and you will find it very difficult to switch out because your files, devices, apps, and workflows are now all interconnected. So the cost to consider here is no longer just about the financials, but also the time, convenience, and familiarity to switch out. The same idea applies to enterprise software. Even if a cheaper AI-generated alternative exists, companies will still need to migrate data, retrain employees, rebuild integrations, and take on operational risk. These switching costs create very real modes that AI cannot easily erase. That's why even though the market is currently pricing companies like Adobe as if their products could easily be replaced, it may not be so straightforward in practice. In one video, Ines shared that even though there are cheaper alternatives such as DaVinci Resolve or Affinity, his team still chooses to stick with Adobe. The reason is because their entire workflow, templates, plugins, and team familiarity are already built around the Adobe ecosystem. He also ran the numbers and estimated that switching tools would result in roughly a 10% drop in productivity across his team. That decline alone would cost the company more than $40,000 a year in additional labor and overhead, which is far higher than roughly the $10,000 annual cost of the software itself. That's why in reality, what is more likely is that the companies replace the least mission-critical software first, such as tools like DocuSign, Monday.com, or other lightweight workflow apps. These products are much easier to swap out because they sit closer to the convenience layer, rather than systems that manage core operations or compliance. The second fear, and probably more significant one, is something known as seat dilution. Traditionally, many software companies generated revenue by charging per employee, or per seat. So the fear is that if AI makes each employee significantly more productive, companies may simply require fewer licenses. For example, instead of needing 100 users, they may only need 30, and that can directly impact the revenue of software companies. However, in response to this, a number of software companies have already begun pivoting towards usage-based or consumption-based pricing. Instead of charging per user, they charge based on AI actions, compute usage, or outcomes. Take Adobe as an example. The company has started monetizing certain AI features through credit systems, effectively shifting from paying for access to paying for usage. Meanwhile, platforms like Salesforce are rolling out agent-based capabilities designed to automate workflows. Now, to be fair, whether this new usage-driven model can fully replace the old seat-based economics still remains to be seen. But in Adobe's case, there's also a possibility that if AI could trigger a content and productivity boom, it could become dramatically easier to create designs, marketing materials, reports, or even code. Organizations may end up producing far more output than before. In that scenario, total software usage could actually increase, even if the number of human users decline. And if usage rises far enough, it could potentially offset part of this revenue loss from seat dilution. In short, AI is clearly disrupting the software companies. But at the same time, it is also expanding what software can do. So the real question is not whether software will be disrupted, but whether these companies can disrupt themselves first and use AI to deliver even more value to their customers. Because in this new cycle, the winners won't be the ones trying to protect the old business model, but the ones willing to rebuild it around AI. Anyway, that's all for this video. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every week.